Thank you for joining us for a webinar today, Top 5 Things You Need to Know as a New Dental Practice Owner. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We'll answer all the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenters today are Matt Vanderloo and Justin Chesbrough. Matt and Justin are both CPAs and principals with SVA's Dental Services Group. They provide advisory, accounting, and tax services to dentists and their businesses. They work with dental practices of all sizes, from solo practices to group practices with multiple locations. Matt and Justin use their knowledge of the dental industry to help dentists on many aspects in their practices, including our topic today about starting your own practice. And with that, I will hand it over to Matt to get us started today.
Thanks, Jennifer. Thank you, everyone, for joining us today for this webinar. We're really excited to share our thoughts with you. SVA's dental team has 45 years of experience working with dentists. Since the inception of SVA as a firm, we've been working with dentists and dental specialists and developing that in-depth industry knowledge that really helps us work with dentists at a deep level, not just on all the typical tax and accounting issues that a dentist might have, but all the very industry-specific, practice-specific issues that might come up in your practice. All the consulting you might need, whether that's on practice valuation or income allocation in your firm, or starting, buying, selling your practice, recruiting a new dentist, hiring staff, whatever it might be. We have the experience that we've seen it before and know how to help you work through that. And with all of our dental clients, what we're really focusing on doing is delivering those measurable results that you want in your practice. And those measurable results might vary from practice to practice, and your goals might be different and very different than another practice's goals. But we can help you define those measurable results and deliver them in your practice. So for today's presentation, we wanted to focus on the top 5 issues we see in new practices with new practice owners. And as we started working on this list, we started with a much longer list and tried to get it down to 5, but we just couldn't do it. So we actually have great 8 ideas that we want to share with you today and topics we want to talk through, from entity structure to staffing within your practice, all the way down to what's really deductible as an expense in your new practice. So all sorts of great topics we're going to cover for you today. Unfortunately, we only have 25 minutes together today, so we're not going to get too deep into any of these. It's going to be a real high-level discussion about each of these topics, but I think there's some great value for you. And put in those questions. If you need us to go a little bit deeper, send us those questions and we'll hit them at the end. So with that, the first big thing we want to talk about is entity structure. And Justin's going to dig into that topic and tell you what you need to know about how to structure your new dental practice.
Thank you, Matt. Good afternoon, everyone. I believe it is afternoon in most of the states that are calling in today. So entity structure. So we want to just again briefly touch base on some high-level items as you're looking to start a practice, acquire a practice, and think about the entity that you should be. So I just want to mention that the organization of your entity is based on the state that you're in. So we do very much advise that you use an attorney that knows dental and often a local attorney that knows dental, because it is different state to state. The organization of the entity starts with the state, and then there are tax elections after that that are made at the federal level. So briefly, an LLC, many people have heard of an LLC. What is it? It's a limited liability company, and its main goal is it does limit the liability of the owner. So the LLC designation is a legal status. That in and of itself is not a tax entity. What an LLC is doing is sheltering the owner from liability, and from there they can make tax elections to determine the actual status of that entity. We broke it down by what is important for a single owner of a dental practice and an entity with multiple owners. So looking at the single owner dental practice, typically a single member LLC, so an attorney will incorporate in the state as a limited liability company, and then there are some options to go from there. You could be a sole proprietor, which is not a separate tax entity. It is just you're filing your individual tax return. You have a schedule on that. that is reporting all the income and expenses, but it's you're a sole proprietor and there's not a separate entity or not a separate tax return, which is the most important thing to think of there. An S corporation is a tax election that an LLC could make, or it's also a tax election that a C corporation could make. There is a separate corporation for an S corporation, and it functions as if it's its own person. The entity is a separate person in the eyes of the IRS. An S corporation is a flow-through entity, so you report your business income and expenses, and it gets reported to the owner on a K-1. Just to kind of illustrate the importance is the new tax law changes that we had a year ago really changed the game for a lot of first-time owners. We had many advisors that had been defaulting and saying, okay, if you're a new dental practice, you need to be an S corporation. I had one lady that recently reached out to me and she said, hey, I'm an S corporation. And once we started to talk and figure out what her goals were, and specifically she did not care to make that much money. She had a fixed amount of money she wanted to make, and she really wanted to focus on the quality of life. And based on the income she wanted to make, it was actually most advantageous tax-wise for her to not be an S corporation and to be a single-member LLC. But again, that was just an advisor that says, okay, well, every dentist should be this. Well, it's not exactly the same for everyone. For multiple owners, we have S corporations and partnerships are the general types. There are C corps as well, but we really want to focus on the ones that we think are the best for most of our clients. Again, an S corporation and a C corporation both flow through income to the owners. A C corporation is more of a corporation. There's a corporate structure. So some of the details beyond this are beyond the scope of today's presentation with the time we have. So we're going to move on to the next slide quickly. So an LLC that's taxed as an S corporation, again, as I mentioned, an LLC is a legal designation. The tax structure and election happens after the actual organization. So S corporation. So the owners or owner, they take payroll checks out of these entities. An LLC or a single member LLC, since there's no entity, there's no payroll, they're making quarterly tax payments just like they would for an individual tax situation. But for an S corporation, you are taking payroll out of it. One of the advantages of an S corporation is that the net profit, so income less expenses including the owner's salary, that residual net income that's left over is not subject to payroll taxes. So main things to think about, an S corporation can be advantageous on a payroll tax savings for certain owners, but a separate tax return is required for an S corporation. So a quick rule of thumb would be if you're expecting profitability in your practice of $200,000 or less, probably a single member LLC is the way to go. If it's going to be above that, start considering an S corporation. There are also some significant differences relating to the sale of a dental practice. Again, probably above today's, the scope of today's presentation, but it is important to consider what's going to happen on the back end when you're setting up your entity as well. The last slide in this section here too then is buildings. You may own just the practice, you may own the practice and the building. We always advise to have the building in a separate entity for additional liability protection. Let's isolate one of the largest assets you have, which is your practice. Let's isolate that asset from the liability of someone slipping and falling outside the building you own. The entity that we typically and almost always recommend for a building is an LLC, while we often recommend an S corporation for the practice. We almost never recommend an S corporation for the building. Various reasons for that, again, pretty tax heavy and above the 25 minutes we have to talk to you. So multiple entities to think about. Don't just, you have to look at your specific situation, and if you have a building, a separate entity, then your practice. And with that, we're going to move on to topic number 2.
The second really big thing we think is important for every new practice owner to consider is you really need to think about the accounting system you're going to use. It's typically for dentists, maybe not the most exciting thing they want to think about for their practice, but it's really essential to have set up and set up well, because that accounting system is going to let you monitor from a financial standpoint how the practice is doing. Are you bringing in more money than you're paying out in expenses? And ultimately, it's going to help us with the tax return and tax planning and all the other important things. There are a variety of different options and different systems out there. And our general opinion is more important than which specific system you're using is that you get the system set up right from the get-go and you use the system well from the get-go. There's all sorts of different products. You've probably heard about some of them like QuickBooks and QuickBooks Online. There's other not as well-known softwares that work really well. And we also have some clients who don't even use a computerized system. They handwrite their checks and send us their check stubs for us to turn into financial statements for them. Any of those is a great option. It really depends on what's going to work best for you as the owner, because at least initially, this is probably going to be one of the things that falls under the task that you have to accomplish in the practice. So it's really important that you use something that works well for you, and it's something that you can easily share with your accountant, your CPA who's working with you. You can use a cloud-based system, or there's other non-cloud-based systems more right on your computer systems that will work really well. But it's important to get it set up right from the beginning, get all the expense accounts you need, all the asset liability accounts you need set up and in the system. And then it's really important to look at the results that are coming out of your accounting system on a regular basis and look at those in conjunction with the reports you're getting out of your dental practice management software to make sure you're monitoring what's going on in your practice, watching for trends, watching for changes, and make sure things are operating the way you think they should. Along with the accounting system, another really important aspect of that right from the get-go is to think about the internal controls, procedures, and policies you're going to put in place in the practice. Initially, especially with the new practice, there probably aren't going to be too many employees in that practice. It's going to be the dentist and just a handful of other people there. And it's really important to do as best you can to segregate all the different duties that are going to happen within the practice. For example, if we're thinking about patient payments, ideally we'd like to have a separate person receiving those patient payments, whether it's directly from the patient or through the mail, a different person posting those payments in your practice software, and then a different person actually depositing those at the bank. So we've got 3 different people touching those. There's not one person who controls that entire process. And that's going to help make sure that those payments are getting posted correctly, recorded correctly, and that nothing's happening to them as they're moving through the process. So as best you can with the limited number of employees you have, you're going to want to separate all that out. One of our other big suggestions, we always encourage practices not to have a signature stamp to get check signs. Don't make it easy for somebody else to put your signature on a check. As time-consuming as it might be, sign all your own checks. Consider background checks for your employees to make sure you're hiring quality employees. And then watch for any changes in your employees' spending habits. That's usually one of the first big signs that something might be going wrong in your practice. If one of your employees suddenly has big spending habit changes that you can't explain in any other way. With that, I'm going to throw it over to Justin for important idea number 3 here, some important tax deductions to consider in your practice.
Thanks, Matt. What is more fun than tax deduction? So let's talk about some of those. So the qualified business income deduction. This is one of the biggest changes that happened in our last tax reform, the Tax Cuts and Jobs Act of 2017. This is, what is it referred to? QBID, again, qualified business income deduction. It's also referred to as the Section 199A deduction, or the 20% business deduction would be another term. So this is a new deduction for 2018 forward that is a 20% potential deduction for flow-through entities. We briefly touched base on the entities before. Flow-through entities are the S corporations, partnerships, and also a sole proprietorship or a single member LLC is potentially eligible for this deduction. This could be for your practice, or it could be for your rental property or the real estate as well. This concept and the whole qualified business income deduction, there are multiple day continuing education classes on this deduction alone, specifically for CPA. So we are really giving you the 10,000 level view of this. It is very complicated in the tax reform that the IRS tried to help, and they originally, I believe some of our politicians said, hey, you're going to be able to file your tax return on a postage stamp. Well, no, you can't. It gets very, very complicated when you own businesses. However, so the main high-level items with this qualified business income deduction, it's a maximum deduction of 20% of the qualified business income, i.e. the income from your practice or the income from your rental potentially. The deduction can be limited, and there's a limitation that's based on 50% of the wages paid in the entity, or for businesses that are a little bit more capital intensive, 25% of the wages plus 2.5% of the fixed asset base. Again, doesn't sound like simplification to me. But for the dental practices, it's really, you're looking at that 50% wage limitation. Now, one of the most important things with this deduction is there's a deduction phase out for service businesses. So what is a service business? The IRS did define that, and the bold highlighted one is in the area of health. Also, there's law, accounting, actuarial, lots of other ones here too. In the original tax law, architects and engineers were also listed out here, and then they have better lobbyists than accountants and dentists apparently, because they got scratched and we still remain in the law. So a dental practice is a healthcare service. This does mean the deduction, the 20% deduction, is limited. Let's get to the next slide to give you a high level of how is that deduction limited. We have three columns here. In the far left column, so it looks at your taxable income before you take this 20% deduction. If you are married filing joint and your income is $321,000, and these are the 2019 phase outs, if you have less than that amount of income and you have flow through business, you will get that 20% deduction. You're eligible for the deduction. There's no limitations following the chart across from left to right. Let's go down one row. If you have income married filing joint of about $320,000 to $420,000, that deduction starts to phase out. So that 20% deduction gets reduced based on the wages and the capital, the percent of the capital assets that we discussed on the previous slide. So if your income then is over $421,000 and you have flow through income from a service business, i.e. from a dental practice, you will actually have a full limitation in place and you will not be eligible for that 20% deduction. However, many new dentists, especially in the first year, if you're buying a practice mid-year and you have half a year, you could very much be eligible for a 20% deduction initially. And again, depending on the profitability of the practice and your overall tax situation. So this 20% deduction is very important, and it really weighs heavily into that initial decision of the type of entity you want to be. You can have a bigger flow-through business deduction depending on the type of entity you choose. Again, don't want to get too much into the weeds now, but it is very important and certainly a thing that you want to keep in the back of your mind and discuss with your advisor as you're making your choice of entity selection. That is our first topic relative to important tax items. So I'm going to pass it over to Matt, and Matt is talking about a specific Wisconsin election next. However, many states are doing similar aspects to help out with deductions like this. So if you're not in Wisconsin, there may be something like this in place or coming your way as well.
Yeah, so the idea here is that part of that 2018 tax reform was that individuals on their individual returns can only deduct the first $10,000 of real estate and state income taxes. So any owners who have their practice in a flow-through entity, S corporation, partnership, LLC, typically the income from that flow-through, the state tax, in this case the Wisconsin tax, would be paid on the owner's individual income tax return at somewhere between 4 and 7.65%, depending on their overall total income. Starting in 2018, Wisconsin put a new provision in that S corporation owners could elect to pay that tax from the S corporation on the S corporation's tax return instead of the individual owners. Got taxed at a flat 7.9% instead of that 4 to 7.65%. So you ended up paying a little bit more Wisconsin tax. But by paying that tax on the S corporation's tax return, the tax got deducted on the S corporation's federal income tax return. So it avoided that $10,000 limit on real estate property sales and in-state income tax deductions on the owner's individual tax return. And this was just for S corporations in 2018. It was expanded to partnerships in 2019 as well. But this is a great opportunity, depending on the income level on your individual return and the income level in the practice, to be able to get around some of those limitations on your individual return and move some expenses over to the corporate return. It's not an easy analysis to understand and make sure that you're taking the best route there and getting the most tax advantage. But it's definitely something that's really important to consider. And as more states look at opportunities like this, it's going to be available to more and more practices all over. So our great idea number 4 for new offices, let's talk, Justin, for a minute about staffing levels in new practices.
All right, we'll talk about staffing, and I know we're already behind schedule, so I'm going to plow through this one pretty quick. Just one quick thing on that Wisconsin pastor entity election. For our clients that were in the top tax rates, it was an effective savings of 2.67% for every dollar of flow-through income they had. So we did have one group of oral surgeons, for example, that were able to each save tens of thousands of dollars by making that election. Practice staffing. At a high level, we get the question, all the time, how should my practice makeup look? We work with lots and lots of dentists, and we've come up with kind of some best practices and some high-level snapshots for you. So if it's a one dentist practice with about $1 million of collections, what would that makeup look like? About 2 hygienists, 2 assistants, one full-time or 2 part-time front desk employees, the dentist, so 7 total employees for a very successful practice collecting $1 million and having a nice overhead level and very profitable for the owner. Staffing up on the next page, really we're just extrapolating this. So you have 3 dentists, each one's collecting $1 million, 2 hygienists per, 2 assistants. Now the front desk, this is where the employees start to be assigned specific duties. It just says, we list 6 front desks, but this is where you have an office manager would be one of those employees. You have a treatment coordinator that works very well for a lot of practices. 3 dentists again, but for $3 million dental practice, multiple owners, what we see for our successful dental practices is about 21 total employees. Again, I mentioned I'd go through that one pretty quick. We did. We have a very exciting one coming up next. Matt, to you.
So another thing we think is really important for new owners to think about is, we've talked about looking at your financial statements, but there's lots of important ratios and metrics other than just what's on the financial statement you're going to want to consider. It might be important for you to look at production per hour or production per day, your collection percentage, your hygiene production ratio, which is how much are the hygienists producing relative to what you're paying them. It might be important for you to look at your new patients every month. How many new patients are you bringing in? How many new starts do you have? The specific ratios that are important to you in your practice are going to vary a lot by your practice, the specialty you're in, or if you're just a general dentist or a specialist. But it's really important you find those ratios, those benchmarks that are going to be important to you in your practice, track those over time, monitor those, see when they're changing, why they're changing, and what you can do to help make them change in the right directions for your practice. We found over the 45 years we've been working with dentists that these ratios and monitoring them and keeping track of them really help improve the profitability and the overall growth in a practice. One of the other things that we really think is important to not just new practices, but all practices, is dental membership plans. Justin, maybe you can walk us through what those look like in a practice.
Absolutely. So dental membership plans, one of the most important things to note, they are not insurance plans. Do not advertise them as such, or you will have the insurance commissioner coming into your practice and disrupting things. They're a membership plan. The patients pay a specific amount, they get a specific benefit, there is no risk, it is not insurance. It can be office-specific discount plans. What you're doing is you're setting a fee per member. Typically that base fee is covering dental exams, cleanings, and x-rays, the usual maintenance. You look at your fee schedule, you add those together, you get a rate, you decide if you want to apply a discount at all to that rate or not. Boom, that is your membership's fee schedule. You do it for one person, you do it for a person plus a child, you can do it for a family, you build off of that, you can have a perio plan. We've helped a lot of dental groups set a fee schedule and create a dental membership plan. There are additional, part of being in the membership is then giving your patients discounts for the non-routine maintenance. We'll often see discounts in the range of 5% to 20% there, depending on the practice. As mentioned, there's different rates for children and perio patients. And again, this is a typical structure. It is practice by practice, so completely customizable. So why would you offer a dental membership plan? You know, and not every practice would necessarily want one. If you have a heavy fee-for-service practice and your patients are paying you and you have very little discounts, well, then there would be in your full, there's no reason to necessarily add it. You are adding this for a variety of reasons, which we'll get onto in the next slide. But what are, again, why would you offer this? So there's practice benefits. Patient loyalty, they're paying you a membership fee, they're going to be loyal to your practice. There are no excuses, they're paying this fee, they will come in for those cleanings. You get them in 2 times a year. Obviously, you can't sell dentistry if they're not in the chair. Get them in the chair, sell dentistry. It's easy access for the patient. The acceptance rates are fantastic once those patients are there. For the patient, what's the benefit for them? Well, it's affordable. You can market these with a monthly rate, whether or not you actually have them pay a monthly rate. Some have them all up front, some have it quarterly, some have monthly payments. Advertising that for the monthly cost of it, it looks very reasonable and is very reasonable for the consumer. So it's budget friendly and there's a lot of clarity. They're very simple. You know what's included, you know what the discount is for services that's not included. It's a very consumer friendly product. So what are those target patients? So if they have no dental insurance through their employer, you know, insurance costs in general keep going up, and patients do not, or employees do not have to elect dental insurance. They may look at the cost of their dental insurance and compare that to your membership plan, and it may be more cost advantageous for them just to have the membership plan, even if they have insurance. But if they don't have insurance, it's a no-brainer. Retired folks, they love dental membership plans. As I mentioned, if the insurance is too expensive, and if they have insurance, they're loyal to you, your practice doesn't accept that insurance, this may be a viable option for them. And we do have a dental membership plan presentation that's specific to it that gets into a lot more details. The next one's coming up March 11, 2020. So if you want more details on that, you know, reach out to Matt or I, or you can register for that webinar. Otherwise, our next topic is one that we get a lot of questions on as far as retirement plans. What are some of the options for a dentist regarding the retirement plans for their company? Matt?
All sorts of different options for a retirement plan for a practice. And I think one of the most important things we like to talk about with new dentists is there's all sorts of different options. Pick one and get started now. Pick one that you think is going to work well for you and for the practice for right now. Get it in place and start contributing. As a young dentist, as a new practice owner, time is on your side. So start making those contributions to a retirement plan. They might not be huge dollars at first, but start getting some dollars in there and start getting those dollars to work for you. There is a variety of different plans, from the simple, literally there's a type of retirement plan called a simple plan, all the way to the very complex. Some that are really cheap and easy to put in place, and some that are going to have a high cost and a lot of work to put in place. Pick one that starts to work for you, that's going to work for you in the practice, get it in place now and start contributing. Plan design is really important depending on how the plan is designed. We might be able to get more of the annual contribution to you as the owner than we're able to give to the employee. So it's really important to think about plan design up front. And the other benefit here, it's not just a great way for you to save for your retirement, it's a great way to attract employees to your practice and to keep employees at your practice. Which in all the markets we work in is becoming more and more difficult for dentists. So last but certainly not least, one of the other big sets of questions we get is, what can I deduct now that I'm a practice owner? What's a deductible expense? Justin, what are some of the key ones a lot of our clients miss initially?
Yep, you had me at deductible, Matt. So we get this question a lot, what can I deduct through my practice? Continuing education, this webinar, 100% fully deductible through your practice. Continuing travel costs relating to continuing education. If there is a education seminar happening in Hawaii, you can certainly deduct the travel costs and that continuing education. Just remember, if you are going to be in Hawaii for 3 weeks and the presentation is only 2 hours, well, then that travel may not be deductible. It could be limited. Basically, in general, you want the business purpose to be more than the personal pleasure purpose. Travel to meet with advisors, certainly deductible. Cell phone, if used for the practice, who does not work with a cell phone? You have a family plan, just don't deduct the entire cost of the family plan. Take a reasonable amount. You can even have a reimbursement plan that says that you'll reimburse dentists of your practice X amount per month for a cell phone. The IRS is pretty generous there. Go for it. Computer at home, again, you're going to be working, checking in the practice while at home. Deduct that computer through the practice. Your dues, your licenses, your memberships for being a dentist, deduct. Charitable contributions or advertising, why do we have a question mark there? There are different limitations at the individual level for charitable contributions. With the new tax law, you may not itemize anymore. It may be much more advantageous to have advertising as opposed to charitable contributions. So when you're looking at the organizations you want to donate to, you may say, hey, I'd like to give you money, but I'd also like you to just put my name on this flyer or give me a little bit something back, so it's more of an advertising or promotional thing for you as opposed to a true charitable contribution through the business. It really goes under the radar in some business owners. You know, that's not the main purpose to be charitable, is to get the deduction. However, you do want to maximize your deductions. So doing it, to do it the right way. Employ your children or spouse through your practice. Again, be smart about it. I probably wouldn't recommend employing your 3-year-old unless you're going to use them for some marketing and throw them on a billboard. However, once they're working age, employ them through the practice. They're going to be in a lower tax bracket than you. The standard deduction for single is $12,000, so you could employ your kid and pay them up to $12,000, and they are paying no income tax on that, and you will have a much higher, you'll get a tax benefit at a much higher rate than zero. Spouse as well, and that could be a way too. Matt talked about retirement plans. If you have a spouse, employ them in the practice, have them work enough so they can at least maximize the deferral allowance based on the retirement plan you have set up. Rental income exclusion at the individual level. If you have a rental activity that is infrequent, essentially less than 14 days a year, you can exclude that income. So if you have a cottage up north, for example, you may want to take your team there for a retreat, for a weekend retreat, pay fair market value rent deductible out of your practice to yourself, and then at the individual level, that rent income is excluded from income. So you just created a deduction where you do not have to pick up the income. One of the biggest deductions is the retirement plan. Matt went through some of the options there. That can be a very significant pre-tax deduction for the practice. The next page, a couple items that may not be deductible. We put vehicle here. We very cautious with this one. If you have one location, one practice, commuting miles aren't deductible. So your first trip of the day, last trip of the day. If you want to be very aggressive with that vehicle, have an in-home office, and then your first trip of the day is from your house to your in-home office, and then after that you got some business miles. However, that's pretty aggressive. Certainly talk to your tax advisor about that one. But in general, if you only have one location, we do not typically recommend deducting the full vehicle. You got multiple locations. If you're a specialist or just have general dentists with multiple locations, it really opens up the door for vehicle deductions, which did increase. The tax benefit potential did increase significantly with the last tax law change. So it's just one to be cautious with. If you have one location, what you can do is you can deduct and reimburse yourself 58 cents per business mile that you travel. So those meeting your colleagues, meeting your advisors, traveling to continuing education, don't forget to give yourself at least 58 cents per mile. The IRS did eliminate entertainment expenses. They gave some deductions, but they took this one away. That does not include an occasional work or holiday party. That one is an employee benefit that's still deductible. But in general, entertainment expenses, those Milwaukee Bucks, Brewers, Nationals tickets, if you're out in Washington, D.C., that is no longer deductible. So we went pretty quickly through that. We went through our 8 points of our top things to consider for new dental practice owners. We hope it was educational, and again, we just scratched the tip of the iceberg, but we wanted to plant some flags in your mind and give you some things to think about. We're going to open it up for questions next.
Yes, I know that we are over the time, but I do want to answer any questions that you may have. Again, if you have any questions out there, feel free to type them into the chat box, and we will stay a bit longer to answer them. We did have a couple of questions that came through during the presentation. So the first one is, how much money can I potentially put away pre-tax?
So I think that you're probably asking about retirement plans and how much money can we potentially put away pre-tax into a retirement plan. I think when people think of retirement plans, they probably most commonly think of some sort of a 401k plan with a profit sharing feature. And if that's the case, the owner could potentially put $56,000 into their retirement plan account every year pre-tax. And in addition to that, there would have to be some contributions potentially for the employees. So the total practice contribution would be more than that, but that's a pretty typical number. However, depending on the type of plan you choose, that number could get much, much higher. There are more complex plans called cash balance pension plans. We've got a number of practices who have those plans in place, and with that plan, for an individual owner, we could get $100,000, maybe even $200,000 into the retirement plan on a pre-tax basis. So it really depends on the type of plan you have and how aggressive you want to be about getting dollars put away each year.
All right, next question. Relating to entities, I heard about SCs. Are those C Corps or S Corps?
Oh, that's a fantastic question. So in SC, the IRS has a designation for corporation. So if you're a corporation and you perform services, you are a service corporation, which that's what the S.C stands for. So you're a corporation that provides services. If you can still be a S Corp for a tax election or a C Corp, which are two different types of tax returns, and be an SC. So the two separate things, but an SC could be either a S corporation or a C corporation. The SC is a different designation. Fantastic question.
All right. Well, we're going to wrap it up here today. If anyone out there has any additional questions for Matt or Justin, their contact information is on the screen. Feel free to reach out to them at any time and they can help you out. Again, I thank Matt and Justin for providing this content for us today, and thank you everyone for attending. Have a good day.